Can you get capital appreciation even before getting your keys? A lot of people think of an investment property as a second property that will be leased out, which they can collect rental from. But did you know that your own property can be an investment as well? This is because a property investment can be multi-dimensional. There's the rental aspect for returns and yield, and there's also the capital gains dimension where your property grows in pricing. Hi, I'm Denise from Propedia. Welcome back to our channel where we share tips and hacks about the property market. I'll leave the link in the description box below for another video that I made previously on how to pick units at a new launch. One of the tips that I've shared previously is how to choose undervalued units. For example, I sold this unit in Commonwealth Towers at the TOP stage. It doesn't have the best view, but it profited significantly more than a unit facing the pool. Developers price their premium facing unit at a higher price, so a pool view unit may not mean a higher capital appreciation in future. Let's look at two units that were sold on the same floor. At the launch stage from the developer, the pool-facing unit was sold almost 300k higher than the non-pool view unit. However, in the resale stage, both units transacted for almost the same pricing. For example, at One Pearl Bank, this 27th floor unit was sold at 2.243 million, while a 24th floor unit was sold at 1.85 million. Given that they are both the same stack, would they command a similar pricing in the resale market in future? The answer is yes, because there will not be a huge gap in pricing between three floors. Hence, choosing an undervalued unit gives you a buffer because your capital gains are sheltered by the higher priced units. By choosing the right unit, you can turn your own home into an investment as well. With this buffer, you'll be assured of profit and capital gains when you wish to exit. Next, by understanding the developer's pricing strategy, you can get a better idea of when to buy. I'll share two of the developer pricing strategies today with you. To put simply, developers are profit-driven companies. In some projects, they may start lower and closer to their base price and stagger their price increments based on demand and supply. For example, if the demand for their 1 and 2 bedrooms are strong, they might start raising the prices for those two unit types. If the market is buoyant, they might even start high to reap the most profit at the start. Let's take a look at Sky Habitat. At the launch, the developer was selling about 20 to 40% higher than its break-even pricing. However, they dropped the prices in 2013 after the cooling measures, with some units even going close to its break-even pricing. And fast forward a few years later, the buyers who bought later when the price dropped actually profited, while those who bought at the start actually suffered a loss. Ultimately, developers are aware there's a fine balance between price and demand. If they increase their pricing too suddenly, they might lose sales. A lot of people assume developers will drop their pricing when they reach TOP to clear stock. However, the truth is that they only drop their pricing if their units are not selling. In fact, projects closer to TOP will get more interest naturally because buyers can move in sooner. Hence, the truth is that developers may actually raise pricing for their last few units because they are aware of this demand. Look at this chart of Gem Residences. Imagine if you had bought the last unit in this stack for 1.888 million. If you had gone in at the right timing, you could have gotten a 3-bedroom in Toa Payoh for a 500k discount from the last unit sold and a comfortable capital gains margin. I hope the tips above were helpful in helping you understand how to choose units and how to choose a timing to enter. If you're facing any issues with a project or unit selection and want a deeper analysis, feel free to reach out to me. Do like, subscribe and follow. See you next time!